Hi traders, Dr. Barry Burns with Top Dog Trading. Okay, this video comes as a special request. I've had some people ask to do a video on how to exactly get into these trades and just kind of make it really crystal clear. So hopefully we will accomplish that goal with this video. We're going to look at a S&P E-mini 2-minute chart for this, but again, entry would be the same whether it's a daily chart of Forex or could be a 500 tick chart of the Russell, or it could be gold or a stock, anything. Entry is the same. So what we do is, first of all, we're looking for a trade. So we don't have one yet, but what we are looking for is a retrace in this trend. Market gapped down this morning, and 50 MA started angling down. We're below the 50 MA, so we're looking for a retrace somewhere, either to hold here, or we got a triple cluster of resistance up here at the 50, 100, and 200 MA. Need our cycle indicator to come up here, come back down. We'd like to get some sort of mini divergence pattern if possible. So let's take a look and see what happens. This is a simulator, so I did it live trading first, but then what happened was everything happened so fast in live trading that there's not enough time to stop and explain it. It takes too much time, and by that time the bars are going away. So I actually deleted that video and decided to just use the simulator so we could take our time and look at it. So I actually went past a little bit where I wanted to. So right here, this bar where the crosshairs are located, we have a single hook on K. Okay, see that? Now if you look over here, so it's this red bar right here. We got a hook down on K, and here's what I'm looking at, the highs and the lows over here. That's going to tell me the high and low of that bar. So since we're going to go short, we're interested in the low of that bar. In this case, it's 1383.50. This is E-signal. It doesn't put a decimal point there before the 50 cents as it should. But anyway, there's no way around that. I've contacted them and their data just doesn't do that. So it's actually 1,383.50. So what we would be doing is, if you wanted to try to take that, you'd be putting a sell stop one tick below the low of that bar, and so it would be, your entry would be 1383.25. So as soon as that bar closes, you actually put in a sell stop, a stop order, and it's a stop order meaning that when the market, well, that order resides there, it just rests there at 1383.25, but it won't be filled unless the market comes down to it, touches it, and then boom, it just has to touch it. It doesn't have to go through it, and then you would be filled. Okay, so that's pretty much it. You just put it in there. Now exactly how you would do that, you know, depends on your execution platform. These execution platforms vary dramatically as to how it actually looks, how the software looks. So I can't tell you how to do that in your software. I'd have to get every execution platform out there and show you. But you know, that's it right there where that vertical line is. So in this particular case now, on that bar, it would actually be 1381 even, because the S&P E-mini moves in 25-cent increments. So the low of the bar is 1381.25, so we would put a sell stop in at 1381 even. Do we get filled? Well, the next bar goes, and no, the low of that bar is 1381.75, so we're still not filled. Could we put in, so what would you do here? Well, you would move your sell stop up to 1381.50, one tick below the low. Okay, unfortunately, when I move my cursor, the prices follow where my cursor is, so I can't point to anything. You just have to look over at that box. That's why I was showing you that box earlier. So the low of this bar is 1381.75, so our entry would be 1381.50. Okay, are we filled? No. We go to the next bar. The low of this bar is 1382 even. So then you'd move your sell stop to 1381.75. Again, 25 cents below that bar. Now, are we filled on the next bar? Yes. The next bar goes down to 1381.50, and therefore you'd be filled at, well, probably 1381.75. You might get a tick of slippage depending on how fast the market's moving and how fast your execution platform is and so forth. Okay. Now, where would your stop go? Well, your stop goes above the highest bar in that cycle high so far. So that'd be the high of the previous bar. So that is right there. And the high there is 1383.75. So again, S&P moves in 25 cent increments, so therefore your entry would be, or your stop, this is where you would get out. This is your stop loss. See, we're using stops to get in, and we're using stops to get out. And I think that's where people get somewhat confused. They're used to the terminology of a stop getting you only out of a position you're already in. But that's not really the most accurate use of that term. A stop can get you in or out, and we use it for both. So in this case, we would call this our stop loss. And our stop loss would be 1384 even, again 25 cents above the high, which is just one tick. That's the smallest increment the S&P moves. So if you're trading a stock, it would be 1 penny above the high, the highest high of that cycle high so far. So you can do this now. Of course, we'd also have to look at the next higher time frame and confirm that that is still in our direction, otherwise we would stay out. Now this is not, the best entry because we just have a single hook down on K. Now D is hooked down too, so that's good, but we really prefer the mini divergences. So let's move on and see the mini divergence pattern. Okay, so there we go, boom. So if you would have taken that trade, you would have been stopped out. You see that? Your stop would be right above here, and boom, you are filled. And so that would be a full boat loser. Now, a couple of things here. Actually, there's three things. Number one, again, we would only take that trade if the next higher time frame confirmed it, meaning percent D was angling in the same direction, in this case, down. Number two, this is not the best scenario because you are actually above the 15 EMA. So the 15 EMA is now below you as support. We don't like to take those trades. We only like to take trades when the 15 EMA is above our entry. Or the only other time we like to take them up when price is above the 15 EMA is if we have an ABC pattern. But on a simple retrace, don't like it so much. And then the third thing is, again, we prefer the mini divergence patterns. Okay, but let's keep going. Alright, so now we have a ABC type pattern, ABC, and now we have a mini divergence type pattern. We actually had a kind of a little mini divergence pattern here too, didn't we, with K. Okay, so now let's look at this carefully. So here's our hook. Now in this particular hook of K, remember you can't trade on this bar because on that bar you don't have a hook on K or D yet. When you get your hook down of K, K gets above 80 and then hooks back down. Then we look for the low of that bar. You got to wait till that bar closes. The low of that bar is 1383.25. So then as soon as that bar closes, we put in a sell stop at 1383 even. 25 cents below the low of that bar. Where's our stop go? Our stop goes above the highest high in this cycle, which is the high of the previous bar in this case. 1385.25 is the high, and therefore our stop loss goes at 1385.50. You just put it in. If it gets filled, it gets filled. So both ways, you're putting in your stops, one tick above this high, one tick below that low, and you wait, and you either get filled or you don't. Now in this case we do, of course. We've already seen the next bar, so we're in. And in this case the market goes down pretty nicely, and it does make a lower low. This is a first retrace and across. It's an ABC pattern. And again here you've got a triple resistance overhead. So pretty high probability. Again, we'd have to look at to know whether either one of these trades was really a legitimate trade. We'd have to pull up a 6-minute chart, 3 times 2 minutes, and just make sure the D was angling in the direction of the trade. But for this video, all we're really doing is pointing out exactly how to enter these stops. Now let's say it's a daily chart for swing traders. How do you place these orders? Well, in one way, it's a little easier for you. It's a little easier because with day trading, you got to be really, really fast, because you have to wait until that bar closes before you can place your order. And you put in that sell stop, and it can, it can go by pretty fast. It can get filled before you are able to snap that trade on. Sometimes that happens, and if that does, well, I pretty much just let it go and wait for the next entry, the next setup. So, but with swing traders, you don't have to worry about that. If that's a daily bar, all you do is you just put in your order for the next day. I just make sure the order is set to only fill during market orders or market hours, very important. And then you also want to put some kind of a limit on it, especially for swing trading. Because if you just put in a stop market order, what happens if the next day the market gap's way down? If this is where you want to get in, but the market gap's way down here, you might get filled here, and you're short here, but then, you've plowed right into support, and the market goes up. No, you want this price here. And so put in a stop limit order as opposed to a stop market order, so that you will only get filled, and you can determine how much you're willing to give up, how much slippage, in other words, you're willing to allow. It depends on the price of the stock, what's reasonable. I usually just keep it within a couple pennies personally. I hardly ever go more than 5 cents. I want the price I want. Sometimes if it's a really, really high price stock, hundreds of dollars per share, I'll go more than 5 cents. But in the price of stocks that I normally trade, about 5 cents is plenty. Should not be trading penny stocks anyway. So, if it's a $50 stock, $100 stock, 5 cents is not too bad. Just to make sure you get in. So anyway, just make sure that you do put it in as a stop limit, so that you are getting your price and not a really bad price if it happens to gap away. So it could still go in your direction, but you don't want to get filled way down here. On day trading, as long as you're not doing too short of a time frame and you're doing a market that has a lot of volume in it, you don't have to worry about that too much. But you're still welcome to use those stop limit orders just to make sure you don't get too much slippage if the market really takes off. Again, it's a good idea, because especially during times like news, or news can come up unexpectedly. A disaster could happen somewhere, and God forbid, but these things do happen. And even on a highly liquid market, boy, markets can go crazy, gaps can happen, systems can go down, and you don't want to get filled someplace you don't want to be. So that's a good precaution to take. Okay, so again, the best thing to do is talk to your broker. Each broker works a little differently, and tell them what you're trying to accomplish and ask them what's the best type of order. They might have a little different terminology. Ask them the best type of order to make sure that you don't get too much slippage on these fills. So hopefully that's very clear. That's for a short example. Obviously everything is the exact opposite for a long example. And then we also have videos in the course that explain the trailing stops.